Well, thank you so much, Jean Motun, and thank you to all the people at Parami, and thank you to everyone watching this, whether it be on Facebook or on Zoom, which I think are the two platforms we're running. It's a really great honour for me to be involved in this. Frankly, anything that Parami does is exciting to me, but I'd have to say this is particularly exciting, this one. The topic, strategy in financial development, could not be more important. And on top of that, the person that we have speaking about it in Professor Sheng is as good as it gets. I mentioned to Andrew earlier that I wasn't going to embarrass him or spend the entire hour or so that we've got together going through his resume. But suffice to say, to anyone who doesn't know Andrew and his work, we're going to hear from someone who has basically done everything. Whether it comes to regulation, and Andrew was head of the Hong Kong Securities Exchange, he was the deputy head of the Hong Kong Monetary Authority. He has, well, he began way back at the University of Bristol with first-class honours in economics, and he's a pro-rector there. He's currently coming to us from the beautiful town of Georgetown in Penang, and where he continues to work and do research and so on. He played a big role in investigating all that went on in the Asian financial crisis 20 odd years ago now, but a whole range of other things that could not be more relevant, I think, to the world, but in particular to Myanmar. Andrew has also told me ahead of time that what he's going to suggest is a little bit radical, but as we discussed just before coming live, these are the times to do it. We're really seeing economists the world over beginning to throw the world book, the rule book out, rather, and to think outside the box, as people would say. So with all of that, I want to maximize the time we're going to hear from Andrew. So I'm going to turn it over to him to tell us his strategy for financial development, with obviously some things that might be relevant to me. Thank you, Andrew, and I'll hand it over to you.
Thank you, Sam, for that generous introduction. I want to thank, Dr. Cho Mo Tun, the president of the Parami University, for this kind invitation. It came through from a very good friend of mine, Lex Riefel, in Washington, D.C. And when I heard about it, I was very excited because Myanmar is one of my favorite countries. I have not visited for quite a while, but the sunrise in Bagan was magical. So when I was asked to lecture on this, I thought since Myanmar is in the stages of economic development, I would share with you all my mistakes. I have been involved, as Sean said, 40 years in financial development, starting with the Central Bank of Malaysia, Bank Negara Malaysia, I was very fortunate to work for one of the greatest of central bank governors, Tun Ismail Muhammad Ali, who was trained at Cambridge, a student of Hayek, and who actually had a very strong views on what financial development meant. And thought I would share this with you because I think it's very, very critical that perhaps an orthodox view of finance is probably very critical to very strong development. Now, as some people may know, finance is the derivative of the real economy. We really care about the real economy, about real jobs, real livelihood. But money is a very important part of this. And so when we think about national development, we must think about the key role of finance in supporting national development. Now, there are two types of development strategy mistakes. First of all, is to make a mistake in way you want to develop your country. The second way is that even if you made the right decision to develop your country, you can make a big mistake in how to finance that development. Okay, so development strategy, mistakes are both in the real side and the financial side. So you have to be good at both. If you make a mistake in one, you can go, get into crisis. Now, most of our finance theory actually came from Britain and America, because Anglo-Saxon economies have been the dominant economies for the last 300-400 years. And a lot of this is influenced by free market liberalism. And this is what you know. But recently, after a whole series of financial crises, in the 80s, the Latin American crisis, in the 90s, the Asian financial crisis, in the 2007, 2008, the global financial crisis, and today we have a pandemic, but we're still also, the pandemic is also a political, economic, and financial crisis at the same time. And part of it is due to the emergence of technology and the invention of central banking quantitative easing. I'll talk a little bit on that issue. So this lecture focuses on how do you strategize finance in this role. So the first overview to remember is that money finances development, right? Now, if you really look at this very important chart by Ray Dalio, who is one of the most successful asset managers today, he has written a book called The World Order about great power rivalry. And if you then look at what has happened in this red line, which is China, and India, which is this broken green line, at around 1500, China and India, being the two of the largest economies, had half the world's GDP. By 1950, India, after colonization, it was reduced from 24% of world GDP to 4%. And China had dropped dramatically, this red line, to slightly more than 6 or 7%. So the situation was that the two largest economy previously, 520 years ago, were the dominant powers of the world, had been reduced to very, very small by the end of the Second World War. Now, then you see that the rise, not just of Britain, which is this, Britain is this black line, and it peaked at around 1850, and then it declined as America came up. Okay, so and then of course Ray Dalio shows the relative strength of America has declined, and the relative strength of China has grown up. Now, a lot of this was due to finance, because how did Britain finance its colonization? Well, partly because of piracy. Actually, as you know, the Prime Minister of England, Harold Macmillan, famously said that the British Empire was founded by pirates, and the government only came in later to deal with this. They robbed the gold and silver ships of the Spaniards, made a lot of money, and then financed that industrialization. Competed with the Dutch and the Portuguese, and then embark on that colonization role. So finance was extremely critical in this game. Now, we are now talking about globalization. So I think it's very important that we understand what globalization is. Globalization is firstly physical. It's about free trade. And free trade comes from the British idea, particularly Adam Smith, that free trade is good for everybody. And it's correct to a large extent, but there are buts there, right? And today, trade networks are basically global supply chains, okay? And it's very expensive to ship goods from A to B, all right? Now, the second network of globalization is finance. Finance is virtual. And you can create finance very readily. And finance is turning over at 15 times world GDP. Okay, so if anybody who finances trade will know, there are 3 to 4 times money turnover for each physical trade, because finance is cheap. But in the last 20 years, we have discovered that finance is also information, and it's a data networks, right? And the data networks is now 20 times the turnover of finance. So because finance, information can be replicated digitally at very, very little cost, right? And so we're looking at physical, finance, and data networks, and then also people flows. Now, because when people migrate, they carry talent, they carry knowledge, they carry skills and culture across borders, but at the same time, it creates tension. And that's why migration is causing populist anti-migration, particularly in Europe and also in America. As you know, President Trump wants to build the Great Wall. So what is finance? Finance are networks, right? They are networks. They are linked to each other. This is a very famous map of all the dependencies between the different networks, and how tightly knit these networks are, right? So what is a banking system? A banking system is basically a network of all its customers. They match the depositors with the borrowers, and they make a margin in between, right? That's and what is an insurance company? An insurance company is a network of customers. They collect all your money and invest it. And if you have some accidents, they pay you according to the insurance policy, right? So all these are networks. Now, what is very important is that previously central banks were a very small part of the game. But today, central banks have learned what is known as quantitative easing, which means that they can expand their balance sheet significantly and influence the quantity of money that there is, right? Now, the latest numbers that are available is that central banks today are $40 trillion, somewhat larger than equal in size of global pension funds, larger than insurance funds, and slightly smaller than mutual funds. But they are growing at 40% a year this year alone. Okay, so the central bank funds are now very important. So, for example, the Bank of Japan already owns half of the Japanese government securities and 75% of Nikkei exchange traded funds. Now, if central banks are so large in financial markets, is it a free market anymore? Definitely not. Okay, so everybody is now looking at central banks to intervene when the stock market drops. So the point that I was trying to make very quickly is that economic development has colonial origins, right? When the US assumed global leadership, they actually forced the decolonization of European powers, right? Particularly after the Suez Canal, in order to reduce competition against her. So but because America, being the leading power, was very interested in global development, development theory became very important after the Second World War, right? Of course, it was influenced by John Maynard Keynes, who was the intellectual father of the American New Deal. Now, there were three schools. The first one is the Adam Smith, Maynard Keynes model of free markets, right? And then, immediately after the Second World War, two schools evolved amongst the newly independent countries. The Indian leader Gandhi was much more interested in the rural areas, and so he wanted, self-reliance. They don't want to rely upon the colonial masters, right? The Latin Americans said, look, we've been exploited by these, American companies, European companies. We want to do our import substitution. We can industrialize by ourselves. And of course, the second solution did not succeed. What really won was the Japanese model. The Japanese said, we want to industrialize and we want to go for exports. And of course, that was supported by the Americans. And when the Japanese succeeded, the Koreans, the Hong Kong, Singapore, Taiwan followed. They were called the Four Dragons. And after their labor became expensive, the four tiger economies, Indonesia, Malaysia, Philippines, and Thailand, follow up to create the global supply, the East Asian supply chain. And then after the Asian crisis, China joined that supply chain. And today, China is the center of the Asian global supply chain, so supplanting even Japan. Although, Japan, Korea, Taiwan are still technological leaders in that area. So how did they finance their situation? And the thing to remember is that, in fact, all East Asian economies are extremely conservative in their financial strategy. They don't run large fiscal deficits. They don't like to print money. Okay, they like to hold very large savings, and they don't like inflation. Okay, so the point about the origins of wealth, this Eric Beinhocker wrote this very powerful book in 2003 called The Origin of Wealth. And origin depends on three technologies: physical technology, social technology, and business models. And it's all about strategy. So the first thing is about scientific strategy. Britain came up because they invented steam engines, right? And then the Americans invented, because of the scale of the American market, iron and steel. And after the Second World War, America became technologically the most powerful scientific nation, in steel, railroads, and then later motor cars, right? But a lot of this was social technology. How do you organize this? I mean, colonization started by two social inventions: the company, which was the Dutch East Indies Company and the British East Indies Company, right? And today, social technology are technological platforms, right? Then the third one is the business model. Because if people are driven by profit, they think about how to make money. And so banks, for example, asset managers have business models. And if you are a regulator, if you are a national policy thinker, you must understand all three. You cannot do only one. Okay, that's very critical. Some nations are very powerful physically in science, right? For example, Soviet Union was very advanced in science. But actually, they did not, their social technology was problematic because the planning system collapsed and their business model was hopeless. They didn't understand, how to use markets and lost. So actually, if you really look at the traditional way of making of finance, it's about traditionally using banks and markets, right? So you have deposits of people, they are the providers of the funds. They went through the banking system, and then these money go to the users of the funds, and the banks create credit and extend the maturity. That's the traditional way of thinking. So the British American model was banks first, then you go into investment banking, then you go into asset management, and then very large pension funds. Then you go into derivative markets, and now today you are in digital finance markets. Okay, so this is the kind of the markets become more and more sophisticated. But Asia basically stuck in the banking system, and so did Europe. Okay, so did Europe. So when the Asian financial crisis came, Alan Greenspan, the chairman of the Fed, made a very famous speech criticizing Asia, saying that you don't have a spare tire. And what did he mean by a spare tire? The spare tire was the stock market. Okay, and the stock market today is part of what is known as the non-bank financial intermediary, sometimes called shadow banking. And this would include money market funds, hedge funds, stock markets, special vehicles, etc. So there are now two channels, okay, two channels. And of course, who is in charge of all of them? Basically the central bank and the financial regulators, right? So now, you understand the basic structure of how the finance works. Now, the very famous American thinker called Walt Rostow said that development is like a plane taking off. Okay, it's very slow to start off with, and then eventually it exponentially take off like that. What Walt Rostow forget is that sometimes the plane crashes, and that is exactly what happened, because in the 80s we had the Latin American debt crisis. Latin American governments were borrowing money like crazy because the American banks became very rich. The American banks started lending to their nearest neighbor. And the old model of Citibank was before, governments don't go bankrupt. Well, they did, okay? And then in the 1970s, guess who went bankrupt? Asian corporations who borrowed too much money. Why did they borrow too much money? Well, because they were given too much money. When the Japanese yen appreciated after the plaza in 1984, the Japanese yen appreciated, and so Japanese manufacturers wanted to retain their business market share. They moved their cheap labor production out of Japan into the Four Dragons and the Four Tigers. And the leading beneficiary was Thailand. So Japanese banks were lending to Japanese manufacturers. Japanese manufacturers lent to their subcomponent suppliers. So Thai businessmen became very rich. Lots of money flowed around. They invested in real estate. They invested in the stock market. They overborrowed, and boom, they went into crisis. And guess what? Of course, as you know, it was not just Thailand that went into the crisis. It was Malaysia, it was Indonesia, and then finally South Korea. And the IMF had a lot of mud on their face because they made a lot of initial mistakes. And surprise, surprise, in 2007, when the subprime crisis happened in the United States and in Europe, both America and Europe made the same mistakes Asia made because they thought it doesn't happen to them. And of course, 10 years later, instead of another financial crisis, we had a global political crisis, starting with Brexit and then the election of Trump. And today we have a pandemic, economic, political, technological, and moral crisis. So we need to think very clearly what mistakes that we made, right? So I'm going to very quickly run through this. Now, so it's quite interesting because the numbers are now available. So if you really look at what's happened, global financial assets at the end of 2017 is already today nearly $400 trillion. Global GDP in 2019 was 87.8 trillion, $88 trillion, right? So global financial assets is 4 times the real asset valuation as measured by GDP. Okay. Now, the growth in 2017 of financial assets was 5.3%. And over this period, it was growing at 5.9%. But look at that. The central banks at 2017 is 30.1 trillion. And today it's 40 trillion, right? Banks is 150 trillion, right? And public institutions are small. Insurance companies are small. The share of assets, 40% are banks. And, the others are pension funds, et cetera, et cetera. So, but guess what? This thing is changing because central banks have grown quite significantly. Okay. Now the issue is that this year the Financial Stability Board has given a report on 2019, published early this year, on the global financial crisis in 2020, and they discovered that shadow banks now account for 48% of total financial assets and particularly vulnerable to liquidity shocks. In March 2020, the Fed increased its balance sheets by 3 trillion, the ECB by 3 trillion, and the Bank of Japan by 1 trillion. And the reason was the shadow banks, the non-bank financial intermediaries, ran out of liquidity as the stock market began to fall, triggered off by the pandemic. Okay, and that's why the central banks are massively in this market. So let me have a very quickly short history. Right? In the 1970s, when I first entered central banking, the biggest banks in the region were British banks, Hong Kong Shanghai Bank, today HSBC, Chartered Bank, and then maybe Citibank, right? The local banks were all very, very local, okay? In the 1980s, the US banks came in and started eating the British bank shares. Okay, they went into corporate banking, private banking, and derivatives trading. So it was at that time when the locals started beginning to take over from the British companies, and they went to the retreat. You may not remember institutions such as Barings, Jardine Fleming, Peregrine, who used to be very well-known local investment bankers and securities houses. But in the 1990s, the Japanese banks became the largest financial institutions in the world. And the US investment banks, Goldman Sachs, Morgan Stanley, Merrill Lynch, began to come in, bought up Barings, bought up Jardine Fleming, bought up Peregrine, etc., etc. And then they became very important players, right? And it was that rush of money into Asia that caused Asia to go into crisis. In the 2000, we had in 2000 the Nasdaq tech bubble. We had Sarbanes-Oxley. We have the rise of exchange traded funds, and now BlackRock, Vanguard. These institutions are 4 trillion in asset size. Asset managers are now bigger than banks. Okay, this is unthink of, in the 70s or the 80s. So what are the major problems? The major problem was that banks in the Asian financial crisis and the global financial crisis were undercapitalized. In Malaysia and Hong Kong, we borrowed the ideas from the Ginnie Mae, Fannie Mae to issue secondary mortgage paper in order to alleviate the maturity mismatch of the banking system. Okay, let me go explain this, because this is quite important. Now, the Asian financial crisis and the global financial crisis were financial crises. And finance has 4 fundamental mismatches. The first mismatch is maturity mismatch. Borrow short-term money to lend long-term money. So when the long-term money needs the cash, you don't have money to pay back your depositors, right? That's a banking structural problem of the banking system. The banking deposits are not more than 1 year in maturity. The loans to mortgages can be 30 years, okay, as long as that. The second mistake is the FX mistake. You borrow foreign currency to invest in local currency. And then when your central bank does not have enough foreign exchange to pay back the foreign lender, you get into a currency crisis. The currency devalues, your corporations go bust. And that's exactly what happened in Asia. And then you have the excess leverage. As you know, if you borrow and you don't increase capital, your leverage increases, but the leverage enables you to make more profit, because but at the risk of higher risk. And the fourth mismatch is what I call the paradigm mismatch. If you don't understand what the market is doing, you are going to make very big mistakes. And in hindsight, that was the mistake that was made in the Asian financial crisis, in the global financial crisis, and this particular crisis. So if we cannot deal with flow issues by only by not ignoring the balance sheets. Okay, if you're an accountant, you would understand this. So the Europeans made the same mistake, by having a fixed exchange rate. Asia made the mistake of linking against the dollar. But when the dollar flew out of the system, they had no dollars, because local central banks, the Bank of Thailand, cannot print dollars. They can only print baht. So we ran out of dollar liquidity and we collapsed, right? I mean, Asian economies collapsed. The same thing happened to South Korean companies. In Europe, they had a fixed exchange rate. So the southern European countries like Portugal, Ireland, Greece, Italy, they cannot print euros. They cannot devalue in order to get the more exports to revive their economy. So the only way is to depend upon the northern Europeans to lend to them. So if you make these mistakes, even though you are a very rich country, you get into deep trouble. Now, what is the global financial system really? It's basically a US dollar dominated system, right? The US dominates global stock markets. The US stock market accounts for 44% of global stock markets. Japan 7.7%, China 9%. The Europeans are the balance, right? The US also dominates the global debt markets. They account for 40% of the global bond markets, right? So, and the reason is that the dollar traditionally has had higher liquidity, cheaper to transact, high transparency, and a very good ROE. The yield on the dollar assets is higher than that relative to Japan or to Europe or to the emerging markets. Okay, but if you are the world's largest debtor, you are vulnerable. And this is a very important issue, and the world is held hostage to the way, the direction the US goes. Now, what's the problem with financialization? Well, there's a very famous elephant curve of global inequality. When the central banks print money, and of course they started printing money after 2007, 2008, suddenly the top 1% captured more than their fair share of wealth, and the bottom half actually, lost, right? So, the population became very angry, all right? So financialization has a downside, which is actually creating inequality. Furthermore, the system has become more over-leveraged, right? So, if I've always said after 2007, 2008, that you cannot solve a debt problem by creating even more debt. But that is exactly what has happened. The financial institutions got over-leveraged, creating the global financial crisis of 2007, 2008. The household has also leverage has increased, and the corporations have also increased. In fact, the government debt has increased significantly. So from the strategic point of view, you must have a financial system that deals with all the four mismatches, right? And because the Asian financial system has been shaped by the dollar-denominated global financial architecture, as interest rates become to zero, Asia is also facing an asset bubble. So housing has become very expensive. The poor people cannot afford housing. They cannot get bank loans. The rich people can get bank loans. Poor people cannot get bank loans. So this is creating a lot of social tension, right? And then, now that the United States sees China as the major rival, this also creates additional risks and tension to global markets. So let me put it this way: if I owe money to you, I am vulnerable, because if you want money back to me from me, and if I can't pay you, I will go bankrupt. Okay. So the best way is, if I finance everything through my equity, my own money, you can't do anything to me, because you can say, pay me, I don't owe you. So why do I worry? So it is the long-term institutional investors that can help Asia invest in long-term infrastructure, to build the roads, to build the highways, to build the ports, to build the electricity, to build the airlines, etc. And when you have very long-term institutional investors, it becomes your spare tire. Now, in the 1990s, Australia was very smart. They realized that Australians were becoming old. So they built up a superannuation, a pension scheme, right? That created the spare tire. So when and as you know, in Australian banking system is dominated by 4 or 5 large banks. Okay, when the global financial crisis happened, the share prices of these Australian bank shares dropped. The superannuation picked them up very cheap. And when the Australian economy recovered, the superannuation pension fund made a lot of money. But who did they make the money for? Not for themselves. They made it for the savers, the pensioners. Okay, so the spare tire is very important. Now, in Malaysia and Singapore, we have very large central and employee provident funds, which amount to 60% of GDP. And these are managed in Malaysia and Singapore by sovereign wealth funds. In the case of Singapore, the Government Investment Corporation and Temasek; in Malaysia, Khazanah. They invest, and they are the bulwarks against speculation, against the local currency, against the Sing dollar, against the Malaysian ringgit, right? So these deep institutional investors are very critical, when your economy gets more sophisticated and more vulnerable to financial shocks. So what has happened in the world of increasing debt? There are more and more hedge funds. Hedge funds borrow cheap money and invest in money where there is higher return. They do what is known as a carry trade. But high liquidity, low interest rate has created high level of speculation, high level of trading, and inequality, right? And this is why today stock markets are booming, because if depositors get zero interest rate on their bank deposits, they move into the stock market, which is more speculative. You can make money, but you can also lose your pension, right? So, the world has become much more tense. So in an interconnected world, you must get your financial structure right to absorb unpredictable shocks. Okay, the world has become more and more vulnerable to financial shocks coming from different parts of the system, and the long-term institutional investors, is very important. But most of all, finance must serve the real sector and not serve its own interests. In very simplistic terms, Wall Street must serve Main Street, not Main Street serving Wall Street. You get it, right? So this is a very critical political dimension to the issue of finance. Now, let me very quickly go back from the financial strategy to what is money. So I told Sean that this is very critical because when central banks previously were very conservative, we used to issue currency only against gold. And then, well, governments may need money. So, okay, we can issue currency against government debt, right? Okay? We rarely issue money against commercial paper, maybe against trade bills, right? So traditional central banks have been very conservative. But today, the central banks are in there buying from everybody. So suddenly, money seems to be becoming magic money. Money can seem to be able to be created overnight. When this happened in 2007, 2008, the people with technology suddenly said, wow, if the central banks can create money, if I invent blockchain, I can create private issued money in which I don't have to be supervised by the central bank, okay, or the tax department, right? So that's how Bitcoin came about. Now, when Bitcoin came about, Bitcoin today is valued at 20,000 US dollars compared to, when it first started, which is less than a few hundred, right? So, suddenly Bitcoin seems to be like gold, it valuation even more than gold. So what is the meaning of that? So I want to spend the remaining bit of my time explaining this issue. So what is digital money? Now, Augustin Carstens is the BIS general manager. He made a very nice paper, right? He called, well, we start off with cash, okay? And cash is widely accessible, all right? And then he had Tumin. Now, what's Tumin? Tumin is actually a Mexican alternative currency. During the Second World War, prisoners of war needed something to exchange for value. And what was the currency? Cigarettes. Okay, so one cigarette, can be exchanged for one, how many cigarettes can be exchanged for one bottle of beer, for example, right? So they created what is known as Tumin. It's peer-to-peer. But the central bank started issuing money. So the central bank issued cash, then increased the bank reserves. So cash plus bank reserves is M0. Cash plus bank reserves plus bank deposits is M1, okay, or M2, right? And then suddenly you created electronic currency, okay? Electronic currency such as Bitcoin, okay? And today, the key question is, should central banks now create a central bank digital currency? Now, what is money? Money is actually information. So information is a property right with value. No information, no market. Why do you trade? You trade because I want something that you have, and you want something that I have. Now, if you have something that you don't want what I have, you may want money instead, right? But money is actually information because the money actually represents both an asset and a liability. The money is the liability of the central bank, but it is your asset. So the key question is, data is free. It has very little value. If you massage that information, analyze it, it becomes information. And then if you analyze that information even further, it becomes valuable knowledge. And the most valuable knowledge is wisdom. Okay? And today, wisdom is technological artificial intelligence, what is called an algo. If I have artificial intelligence and algo better than yours, I can even beat you in chess or in Go, the game of Go, right? And the same way, if I have like Facebook, if I have Facebook 2 billion customers, and I know what my 2 billion customers are doing, I have superior knowledge to any one of you. So if Libra, if Facebook issues Libra, a currency, they will have 2 billion customers. Okay? The largest bank in the world has 150 million customers. That's considered big already. How to compete against, Facebook, which has a price equity ratio of 40, and a bank, the largest bank in the world, has a PE ratio of 10, right? So the competition is very unfair. But remember this, information can be negative. There can be misinformation and disinformation. So the game now is a strategy game in which if you have superior knowledge, superior wisdom, superior data, you beat your opponents. So let me very quickly run through this. So once you understand that, you must understand that information is physical. Now, this is a very important paper by Cesar Hidalgo, who is a professor at MIT. He's a physicist. He wrote this book, about physical money, right? Information is physical. Now, finance is information stored in physical ledgers. Okay, in the old days, it was a book ledger. But today, it's actually a hierarchical or distributed network ledger. I use the example of a battery. Energy is a flow. You put your energy into the battery to store it. But if the battery leaks, you destroy value. So value created, value stored, and the leakage is value destroyed. So what is a bank? A bank takes the flow of deposits, stored it in the bank, lend it out as loans. And if there are non-performing loans, loan losses, corruption, stealing, you have losses. That's why banks need to be supervised. Okay? They are storage of value, storage of money. So what is finance? Finance is information across networks. Now, what is the current ledger system? Well, suppose I want to pay somebody in Myanmar. I would instruct my bank in Malaysia, let's call it CIMB Bank, right? Please transfer $100 to my friend, let's say Jessica, in Myanmar, in Yangon. What will CIMB Bank do? CIMB will instruct Citibank in New York to transfer $100 to the correspondent bank of Jessica's bank in Myanmar. Let's call it Myanmar National Bank. I don't know the name, but let's call it Yangon Bank. Yangon Bank's correspondent bank in New York is JP Morgan. Okay? Citibank will transfer $100 across the books of the US Fed to JP Morgan. JP Morgan will instruct the Yangon Bank to tell Jessica that $100 has arrived. So it's hierarchical. It goes up a curve, and the Fed can see every US dollar transaction. You get it? What is a distributed blockchain ledger system? It is a system in which we do not transfer the money across a bank or across the Fed or a central bank. We go through one instruction to a block where the information is digitized and encrypted. It goes to another block, again digitized. It is very difficult for someone to intervene and hack that information. So it is a flat peer-to-peer system without the intervention of central banks, ministries of finance, tax department, etc., etc. It's that simple. It's not that complicated. Okay? But the key question is, do you believe that distributed ledger systems cannot be hacked? And that, of course, is the big mistake. Because as you know, with innovation, there is no such thing as unhackable computer systems. All right? Okay? The logic is very simple. If you invent a 40-foot wall, somebody will invent a 41-foot ladder. Okay, so you must remember this. It is nothing is unbreakable. So that's basically about digital money. So let me now finish. This lecture has told you about how to think about money, how to think about finance. Finance is a derivative of the real economy, but finance also influences the real economy, and the real economy also influences finance, right? We are very lucky because East Asia, particularly ASEAN, of which Myanmar is a member, is in a geopolitical sweet spot. Everybody needs ASEAN. We are the fastest growing region because we are a very young population. We are highly tech savvy, and we are moving into high growth. Okay, right? But remember, finance must serve the real sector. We must understand we cannot be controlled by finance. We must control finance in order to serve the people. Okay, so we need a thought leadership. Myanmar is a latecomer in development, has a very young population, very clever people, and there is what is known as a demographic dividend. That means you are growing, you are young, you will contribute to global labor supply, but you must get your development and finance strategy right. And that is all about how to think about national and business models to learn, adapt to lifelong learning, because life is getting more and more complicated, right? We're moving into the quantum age. It's faster, it is bigger, it's more complex. But never worry about crisis, because crisis always bring opportunities. Those who reform fastest will be the winner in today's crisis. So on that note, thank you very much. I hope I will be able to answer the question for the rest of the lecture. Thank you very much indeed.
Well, thank you very much, Professor Sheng. I'm sure you've given us all so many things to think about, actually, and I must admit I've got a full page of things from your wonderful remarks. Just looking at the questions as well, there's a few that has come in, and I might put some to them if I may. One of them is a very precise question, but I might broaden it out a little bit. So somebody has asked the question, for what purposes do banks create their own cryptocurrencies? Andrew, I'm just wondering if I can broaden that out a little bit, though, just to say that, of course, sometimes it's not banks that are major players in these cryptocurrencies. And I wonder if we could get you to reflect on the way in which what would seem to be the great competitors of banks now, in the form of Ant Financial and WeChat Pay, these new ecosystems of digital money and bolt-on financial services around them, to what extent do you think they're in competition with the banks? And to what extent do you think their cryptocurrencies broadly are in competition with governments and central banks? Because, of course, they're creating monetary assets that are not issued by central banks. And countries like China seem to be getting increasingly worried about some of the creatures that are being created in China and other places. So I guess the overall question then is just some thoughts, a little bit more thoughts perhaps on cryptocurrencies and the degree to which they provide competition to incumbent players.
Well, you must remember that the arrival of tech platforms was very recent. I started paying attention to this 5 years ago. And I gave a lecture to some of the top bankers in Singapore. They're not from Singapore, they're from the region. And I said, you guys don't understand. The tech platforms will eat your lunch. Okay? And if you don't get it, you really must be prepared for intensive competition. Why is that? What is the business model of iPhone? It's not the telephone. It's a style, right? It's very cool to have iPhones because I can have iPods, AirPods, iPads, right? Mac Pro, right? The whole chain, and then I have apps, etc., etc. The point about the customer is that the tech platforms pay attention to the customer. And almost everybody now has a smartphone. So the banks sit there, wait for the customer to come to the bank. The ant finance is in your hand, right? The joke 2 years ago when I went to Shanghai, there was somebody who was a beggar. There shouldn't be any beggars, but the beggar did not want money. They wanted me to wiggle my iPhone with them, okay? Which goes to show that people think now very, tech-oriented. It's very cool to change money through the iPhone, right? Through your smartphone. So the tech platforms are very large. They are very powerful. They have become too big to fail. Okay, and the banks and the central banks are still saying, "Oh, we must protect our banks. We should be very careful about the technology." Banks have a lot of data about their customers, but they never analyze such data. Whereas people like Alibaba, like Tencent, like Facebook, they analyze that data and they know more about you than you yourself. Okay? So, for example, you all know this. The minute I buy a book in Amazon, what happens? Suddenly, I get ads coming to me saying, "You have bought this book. Why don't you buy this other one? You have now bought this flower for your wife. Or why don't you buy this piece of jewelry for your wife?" Okay, right? So all this is to your convenience. Guess what? With a bank, normally a bank, oh, you must come in. You must go before the security guard. Oh, then there's a glass case between them. Oh, did you bring your IC, your papers? If you don't, please go home and come back again. Forget it. Through my iPhone, I make payment immediately, anywhere in the world, right? And an instant. So the result is the convenience to the customer has changed the whole game. And unless the banks, the central banks, the regulators understand this, okay, you will always be at a disadvantage. Now, it's very tough for a newly developing country such as Myanmar for their banks to get that technology. Okay, this technology is not always available, but there's nothing to cooperate. And some people say, well, they take all your information. My standard answer is, do you realize that Apple or Google know me better than myself? On my iPhone, they know when through the GPS, there is an app which you can download telling you which part of the house you have been and whether you have been to the toilet, you have been to the supermarket, etc. So today, Google provides mobility data on every country, every district even, who goes to the supermarket, who has been traveling on a train, who has been on the road, etc., etc. This is phenomenal. This changes the whole ball game. Okay, so that is what I meant by the paradigm mismatch. If you are still looking at 21st century with 20th century glasses, which most of us are still using, we have got serious problems on our hands. We need to change our mindset very, very fast.
Thanks, Andrew. So that question came from Facebook. I'll draw another one now from the Zoom meeting itself and then go back to some others that have come through on Facebook as well. But one that came up in our Zoom meeting itself, somebody has asked, how would you regulate digital or neobanks in countries like Myanmar? And I guess the question there is, would you do a sort of light touch or heavy touch? What would be your approach?
Well, this is a very difficult question, right? Because it's first and foremost, it's a political question. Okay. So, for example, let's be blunt about this. China did not allow Facebook in China, right? So they created their own Youku, right? The Indians and Indonesia welcome Facebook, welcome Google, and today the local Indonesians and the local Indians have difficulty getting such data, right? Because who has most of the data, digital data? The big tech platforms. Now you can request them for it, but if you don't have data, you're not in a position to compete. Okay, so to a large extent, the countries with very large populations, such as Indonesia and India, they are beginning to develop their own tech platforms in competition, sometimes in cooperation. So if you're in Myanmar, the choice that you really have to make is to decide on what conditions that you would request them to provide you information on. All right, and that of course is extremely sensitive because there are privacy, implementation, privacy issues on this area. But to a large extent, if you don't have information, you're out of the game. You don't have data, because everything is about big data and AI, right? So sometimes when so I would suggest that the Myanmar government talk to these tech platforms and argue, under what conditions can we have access to that data?
Some other questions coming in, Andrew. People are very interested in your experience and role as a regulator. And a direct question that's come in, again in the Zoom meeting, is just about Myanmar's situation with respect to non-performing loans. So it's a bit of an open secret that Myanmar's banks have fairly large volumes of NPL sitting on their books. Based on your experience, what would you suggest in terms of a roadmap for deleveraging a system where there could be lots of NPLs, perhaps tied up with real estate collateral and the like?
Well, my experience is that all countries have non-performing loans. Okay, I mean, please don't think that advanced countries don't have non-performing loans. The reason why the Europeans recently got into a banking crisis was because the banks had non-performing loans, except that the non-performing loans some of them were governments and a lot of them were actually corporations, particularly Northern European banks lending to Southern European countries, borrowers, either governments, corporations, or mortgages, etc. So non-performing loans is part of life. The real issue is commercial banking the right model for your stage of development? And I think people have not understood the power of digital platforms and the power of the poor, right? So for example, do you know that in Indonesia, they have what is known as wet market banking? What is wet market banking? A bank takes a truck that drives to the wet market, the local rural market, open the door and says, anybody, and they go 5 o'clock in the morning. Okay? And then they tell everybody, anybody wants $100 with no collateral, you can borrow $100. You must repay me $110 at the end of the day. Now, a lot of poor people actually were willing to borrow that $100 because in the wet market, they can sell the product for $130. Okay, right? But can you imagine $10, 10% interest rate for 1 day? It's phenomenal. But the non-performing loan risks are actually very small because every poor person knows that if they don't pay the bank, very soon, the next time they come around to borrow, they'll never get it. Okay? So actually, people tend to forget that the poor people actually will repay their loans if it is within their culture to do so. So, for example, in many countries, they discovered that lending to women has very low non-performing loans, right? And if you know how to lend, you may not even need collateral. So, for example, the Taobao, the Alibaba equivalent, they have such good information on the on the trading experience of their customers that their non-performing loans are significantly lower than the banks, right? So to a large extent, every country have to invent their own distinctive models. And I know that Myanmar is a country with many different tribes and population, so with different customs. Now, so that you cannot apply banking that works in America to Myanmar and expect the same results. It's all about localization, not globalization. Localization. How do you localize global knowledge? Right? And that's very, very critical.
A very big question that's come. It's actually on both of our platforms, Andrew, but it's about as big as you can get, which is a question that says, how do we incentivize Wall Street to act in the interests of Main Street?
I've given up hope on that area. As I think Alan Greenspan himself said, he did not realize how greedy Wall Street was. But having the right incentives matters. So you should not worry too much about Wall Street at this stage. I think what you should really be concerned about is not to be too fancy in delivering very complicated products. This is why I was against Basel III. It's just too complicated. We need, if we are at kindergarten, we need kindergarten rules. If we're in secondary school, we need secondary school rules. We don't need very complicated university rules, okay, for kindergarten, right? And that's why it's fit for purpose, best fit rather than best practice, right? Wall Street companies can afford to hire the best lawyers, the best technologists, and the best compliance officers. When you are a poor bank, a rural bank, how do you comply with Basel III? Because some of your officers don't even understand these complicated rules, and especially these very sophisticated models, right? So you have to work very, very simply. Don't try to overcomplicate matters for your people.
What's pleasing on that score, Andrew, there seems to be a bit of a consensus now on that, isn't it? That Basel III is just way too complex. Another very big question for you. Somebody has asked on Facebook, what would a global financial system look like that did not have the US dollar or any other national currency at its core?
Well, in the global system, there will always be the equivalent of the US dollar. Okay, the complication of the US dollar is what the Belgian economist Robert Triffin called the N+1 problem. If you have n number of countries, and you use a national currency as the major currency to trade amongst them, there is an inherent exorbitant privilege for that nth country. So to be totally neutral, you need to have an N+1 currency to solve the complexity in the system, right? And that N+1 currency, Robert Triffin called the SDR, the special drawing rights of the IMF. But because the US dollar is a component of the SDR, and the US is a major shareholder of the IMF, they will never allow the SDR to compete against the US dollar. And that's why the problem today is that the US is the equivalent of the central bank of the world, but the US is also the world's largest too big to fail borrower. This is a dilemma. So it is a special privilege and it's somewhat also a special curse, right? And now the problem is that if somebody is sanctioned because they are using the US dollar, do you use the US dollar at all? And that's another very, very big question.
Another smaller question, this time directed at the Myanmar market, Andrew, ask your opinion of the invisible hand and its role in the Myanmar financial sector. I don't know whether you feel like you'd like to have a stab at that.
Well, the market is self-order, okay? And Hayek was very correct in saying that the invisible hand is the self-order of the market. When many people are doing, very different things, sometimes the order appears by itself, okay? The point that I want to make is that the idea between the state and the market as binary, state or market, is wrong. It's actually a logical error. There is no market without state and no state without market. It's state and market. And what people also tend to forget, and I think Hayek was not willing to accept this, is that even the state has self-order. The state is a very large bureaucracy, and the bureaucracy, the interest of the bureaucracy is not always the same as the market. And it is also not necessarily the same as the people who control the state. Okay? So for example, why is President Trump always complaining about his bureaucracy, that they never listen to what he wants to say? It's because the bureaucracy, follows the rule of law and does not necessarily agree with what he does. There are some people who do, but not necessarily. So bureaucracies are very large and also have their self-order. Okay, and bureaucracy defends its own interests, not necessarily the interests of the consumer or the citizen, right? So to be very realistic, you cannot be too idealistic in dealing with the state and market. Okay, to assume that democratic institutions will grow overnight in a country with 1,000 years of history and very different institutions is unrealistic. You have to be extremely pragmatic. You build the market. If you don't have a market, you need to build it step by step. And it sometimes takes generations to do this. With technology, you can do it a little bit faster. But even with technology, as we now know, technology is highly concentrated. A few tech platforms control everything, right? So we have not yet been able, and these tech platforms are large governments. They are larger than governments. They have 2 billion over customers, right? How many countries have 2 billion customers? Not many, right? Even the largest two countries, India and China, have only 1.3, 1.4 billion. Okay, so the power of governments, of these tech platforms, are tremendous. Each of these platforms are now worth, some of them are worth $2 trillion. Okay, so they're extremely powerful, very big and very powerful, right? So so in the end, all these are very difficult political questions that even the largest of countries have not been able to solve.
Given the time, this might have to be the last question, I think, but it's a particularly insightful one. And I think it's insightful both for the nature of the question, but also that it's directed at you, Andrew, because it seems to me that your roles as both a regulator and an educator will almost uniquely equip you to answer this question. So I'll read the question. It says, higher education is often identified as being a partner in crime in some of the excesses of the financial sector. So at a new and already respected institution like Paradigm, what role do you think higher education needs to play in making sure that financial sector works for the interests of, well, back to that earlier question, perhaps the interests of Main Street rather than Wall Street?
Yeah, I think that's an excellent question. The problem about finance is that is finance for the masses or finance for the elite? The same question, because if you accept what I was saying, is that finance is information, okay? And if information is highly concentrated, does it serve the masses or is it the master of the masses? All right. So the university is the same thing. Is the university only for the elite or is the university for the masses? Right? If the elite are educated and the non-elite, the masses, are not educated, this is very unfair. And that is why the internet has in fact made people, everybody has access to knowledge, right? This is very good, but not everybody has access to the mobile phone, to 5G, to 4G, or even 3G, right? And so the result is, and the information on the internet, as you all know, some of it is very bad, right? It's misleading information, it's biased information, it's disinformation. So we are paying a very high price for not educating our people to think for themselves. Oh, just because this very famous movie star says that I must use this particular thing, I must have it. Why? Right? I mean, the point is that we are induced to think for the elite. So, as Joe Stiglitz said, the real danger comes is not of the people, by the people, for the people. It's 1% of the 1% for the 1%. And that is very dangerous. Okay, so universities must serve the people, must serve the community. This is extremely important. The reason why some of the best universities in the world succeeded was because they attracted talent from the lowest of the classes, that anybody from the most poorest village have a chance to get a degree at a top university. That is very good. But if the person who gets that degree forgets his people or her people, that's very bad. You see, right? So I think, it is of the people, for the people. This is not about democracy or whatever. It is really a reality that information and knowledge is how human beings progress. And the way you progress is through additional knowledge, right? And hopefully wisdom. And the universities have grown because they cultivate exactly like a garden to tenderly protect, educate, nurture these to become big trees. Okay, and create diversity from this, right? And when people have become self-sufficient, they are reliant, they are open-minded, they know how to help others, then your society will succeed, your community will succeed. Success is not about elites. Success is for the masses, and that's a very important message. So, I think the reason why, I feel that Parami is a very, very good idea is because you want to give back to the people.
Well, that was a superb answer, Andrew, I think, and it captures exactly, as you say, what I think Parami is about, which is attracting talent, not forgetting, building big trees. Seems to be what is the game that Chua Motun and all the people at Parami there are about. So thank you so much, Andrew, again. Thank you to all the participants. I must apologise to those whose questions I didn't get to. There were some little things here and there. Many other questions we could have put to you. Andrew, I don't want you to answer this, but I think we're going to have to get you back at some time because I want to ask you what you think of modern monetary theory, but I don't want you to answer it now. I want you to come back and answer that full at some time in the future. So thank you, sir. It was an absolute delight. And as mentioned earlier, thank you to all the participants. And looking at the names, I can see that people have come in from all over the world. There are people from Washington, from Sydney, from Georgetown, from Yangon, from London, everywhere with our audience tonight. I'll bring my comments to an end there as well. And I might just check back to see whether Jorma Tun wants some last comments that he might want to make to bring things to a close. But I think for my part, I think it was a fantastic success, and thank you again to Professor Sheng.
Dr. Cho, do you want to say something? If not, I just want to say thank you very much for the honor. Maybe Dr. Cho's mic is off.
Or he's out there cultivating that garden, I think, we were talking about.
Hi, can you hear me?
Hi. Yes.
Because we have a system so that the host, Jessica, is muting everybody. So I can unmute myself.
Right.
That's why. Thank you very much. This has been such a delight. I mean, I watched Inside Job documentary quite some time ago, actually a few years ago, and when Lex Rieffel introduced or told me about you, and then we finally had a chance to meet via Zoom. I was like, I think that I have seen this person before. So I mean, even in that movie, it was I kind of was very honored to hear you speak directly from Zoom, and then I was actually very I felt very fortunate and honored to be introduced to you through our trustee, Lex Rieffel. And again, thank you very much for this talk. I learned a lot from this talk alone about Bitcoins and everything, and also how higher education needs to be constantly evaluating itself to meet the needs of the people and for the people, not for the elite itself. And again, I have talked to my faculty members at Parami before. I don't want to be complicit in creating an unfair society through Parami either. And my academic director said, Philmoton, one step at a time. We need to constantly evaluate ourselves. And Catherine, who asked the question, was absolutely right. We really need to carefully evaluate ourselves all the time. In that documentary in Inside Job, many economists themselves were part of the problems in creating many of the disasters that we saw. And so I hope that Parami can meet your expectations in that manner in the future. And when we're going wrong, or if I'm going anywhere wrong, please advise me to do so as well. With that, I would like to very much thank you for your talk. And it must be very late for you, Sean, as well.
Well, thank you very much, Dr. Cho and Sean, for moderating. It's a real pleasure meeting all of you across Zoom. To me, meeting the young is what keeps me young, okay? So it's been great fun, and I hope we have more opportunities to talk in the future. Thank you, and good night, all right?
Thank you so much.
Merry Christmas and Happy New Year, everybody, okay? Bye-bye, all right?
Bye-bye.
Bye, everyone.
Bye-bye.